Hi everyone. I'm here today because I think it's quite important for the people who have heard about trading with gamma exposure. And when they come to the channel and when they come to Gexbot, try to learn. They think that because we have classic state and order flow, they try to go to the most advanced tools. But what I want to show you today is how Gexbot Classic, is so good, and I can give you a good edge in the market. Is the power of position analysis in only one tool. And even myself and other kind of more experienced traders on using guess exposure in our day-to-day trading, we're still using Classic, right? And I'm going to show you today why. So if you're new to gamma exposure, trading with gamma exposure, this is a good video you need to watch, because I'm going to explain how you can take advantage of the market, how you can start with Gexbot only using this simple tool and yet so powerful. So let's dive in. What's the foundation? What is Gexbot Classic? Right. If you can see, Gexbot Classic is a ladder style histogram, that show you what you see here is the gamma exposure. It gives you two readings, one by open interest and one by volume, right? The one by volume is the one that we are tracking, the one we are interested in, right? So in simple terms, what is it telling you? It's telling you how much institutional money is being allocated into calls, which is the green one, or into puts, which are the red ones, right? And in the middle, we have what is called the zero gamma, which has an interesting calculation, and I'll explain it later. But this is also a very key element. So anyway, calls, when you see all these calls, basically the profile is telling us that if there are enough calls, there are more calls than puts, that might push the market up, right? So all these bars extending to the right is kind of bullish gamma exposure, or it is a bullish gamma exposure. Puts are the red bars extended to the left, which are bearish gamma exposure, right? We have something very interesting, and I'll explain everything, but it's the same as the other state and is this state kind of profile, but I'll explain how, when we can see how the market participants or the institutions, they are all positioning themselves in the options market. On these dots, with these dots, we can see when they are adding more gamma exposure to the downside, for instance, in this example, or when they are liquidating all the gamma exposure. In this example is, I believe, the very close the end of the day. If you can see, is like 2:30. You can see like the market has been trending down, and we can see how all these participants in the market are taking profits. Why? Because these dots, it tell us like 1 minute, 5 minutes, 10 minutes, and 30, 15 minutes, and 30 minutes ago, where all those negative gamma exposure were positioning before. And you can see as they move to the right, so it basically say that all these participants are taking profits, right? And they are reducing the gamma exposure. But anyway, let's gonna get with more details into this. So if you want to have 1 or 2 trades per day, right? High probable trades with a high probability of success, right? Classic is what you need, right? So why? So the key to high probability trades is trade only on the major gamma levels, right? So the major positive gamma usually acts as a resistance, right? Think of this as a ceiling. When price hit this level or is very close to this level, market makers, they sell into strength, right? Making tough for the price to push higher. But it's not that the market makers decide to sell, futures on this level. Is that options participants, right? They were positioning themselves on the way up, right? And once they reach this target, they take profits. It has to do with something which is called gamma 25 and gamma 50, which I'm going to explain later. And why these guys in the options market, they prefer to take profits on these levels, right? So this is trade number 1. Basically, you have to wait for the price to go up to the major positive gamma. this is a resistance. You don't buy here. What you do is you're selling here, right? Because again, options participants as an example, if they've been buying structures in the options market which are bullish, they take profits here. And once they take profits, they basically liquidate all the options positions. Market maker who has been kind of buying futures to hedge this portfolio to be delta neutral, once all these market participants start to liquidate their positions, he needs to sell all the futures that he bought, right? So this is trade number one. Sell on strength, sell on this ceiling, right? Don't sell in the middle here. Just wait for the price to reach these important and critical levels. Now, the opposite of that is to buy on major negative gamma. This acts as a support. Sometimes you can buy just before and put your stop loss below, right? This is a strong floor, right? Where market makers buy into weakness. So basically absorbing all the selling pressure. And again, it's not that market makers decide to buy into weakness. Is that options participants who were putting structures of they trade volatility, but they put in instructions when the market goes down. When they go to these important levels, they start to liquidate their positions, right? They take profits. It's like any other trader. If you are short in the futures markets, you take profits somewhere, right? These guys, they tend to take profits in the options markets around this major negative gamma. So this is trade number two. If you are short for any reason, just think about take profits here. And if it's early in the day or midday, be careful at the end of the day. But if you see the market reach one of these levels, you can go long on this, right? So this is how you use these two major positive gamma and major negative gamma to enter a trade. Go short on major positive gamma, right? Or if you're being long, this is the place you take profit and go long in major negative gamma. Or if you've been short, you take profits here. Okay. Now, why this happens? Trades with the highest probability happens at this level because they act as a natural turning points or mean reverting, right? As an example for us futures traders, if you are buying NQ or MNQ into a major positive gamma, right? You don't buy here because you are running into a wall. But if you wait for the price to hit a major negative gamma here, that's where buyers step in, right? And that's where you have two market participants stepping in these levels, because it's very sophisticated traders and very clever traders. They use gamma exposure to see where they can get into the market. So you got two groups of traders basically taking a long position here. First is the options guys who take profits from their short structures, right? It's like they taking profits, so they liquidate their short positions. Let's put it that way because they trade volatility. It's not a short position as such, but as they liquidate their positions, market maker needs to buy, right? To cover the futures they've been selling. The market maker has been selling to be delta neutral. And also other sophisticated traders, they know these gamma levels, and what they do, they also buy the futures, right? So this is where this level, the major negative gamma, is the place that where buyers step in, and this offers a great opportunity. We've seen it. We got statistics on this, and I use it. I use the most advanced tools in Gexbot, but day by day, this is one of my main setups. I look on this every day. It's one of my main screens. So why is this happening? You guys you see a long green bar on the right, a long red bar to the left. So why is that? Why you guys must asking, guys, why is Freddy telling me this to buy here and sell here? Well, the mathematical reason, and I'm gonna try to explain it very easily, is the options guys, they don't trade direction, they trade volatility, right? And they have to be aware of the Greeks. Probably you guys have heard of the Greeks, which are delta, gamma, theta, charm, vega, right? But for 0DT And remember, we are trading 0DT options, or I mean, we're not trading 0DT. We're following the guys who trade 0DT options because we trade in the futures market. So for these guys trading 0DT, they have something which is the gamma profile, right? So once the gamma profile reach what is called the 25 gamma or the 50 gamma, see, this is the graph for the gamma profile. So as the stock price rise, let's say this is SPX, I believe. As the SPX rise, you see how the gamma profile, goes upward sloping. And between the 25 delta and the 50 delta of the 25 gamma, 50 gamma, it is decreasing. This is like a bell curve. So why is this important? Because as the gamma profile decrease, look, the price is still going up. Let's imagine this is some option structure which is benefit if the price goes up, right? Basically, they're buying options, let's say. If the price keep going up, look how the gamma diminishes returns, right? So when you trade options, this is the place where you take profits, because it doesn't matter if the price keep going higher, your returns are going to be diminishing, right? We can see it here as well on the delta progression, right? Between the out of the money options, let's say this is an out of the money options, when they reach the 25 delta, look how the exponential moves is. What happened with this is if you buy options, you want to sell it, right, at a higher price. So when you buy out of the money options and they reach your 25 delta, this is the maximum kind of appreciation in value for that options. Once it passes the 25 delta, it goes to the 50, right? And you see all this kind of upward slope movement from the delta, which basically makes the option more expensive. And if these guys bought these options, they want to sell it at the highest price, right? What's the highest probability of selling with the highest price? Here, when you reach the 50 delta, you see it by gamma exposure. And in here, when the delta, the biggest move, exponential, let's put it that way, exponential move happens between 0 and the 50 gamma or the 50 delta. Pass through that level, yeah, it might continue to go up, but look, the slope is not as exponential as the first part. And why is this important? Because options traders, they also, especially for 0DT, they are scared of theta, right? Theta is the derivative that tells them that basically it's time, which decrease the value of the options, right? Theta goes against the option. As the option approaches to expire, which is at 4 o'clock New York time or ET time, this theta, minute by minute, start to reduce the profits from the options guys, right? So that's why when these guys go to these maximum levels, that's it. They get out of it, right? If they're bullish in nature for any options structure, they're gonna take profits here, and we know why. Because past that point, the returns are gonna be diminishing, and the delta profile, the delta progression is not gonna be as exponential as before, right? And they have theta, right? So that's why when you guys trade with gamma exposure, you also have to be aware of the time. It's not the same if the price reach or goes down to the major negative level at 10 o'clock in the morning, 11 o'clock in the morning, that if it goes at 3 p.m., right? Because at 3 p.m., these options, 0DT options, they only have 1 hour to live, right? So they expire at 4 o'clock, so they only have 1 hour. And theta is crazy. Honestly, I've been trading options 0DT, and the way theta influence the price of these options is crazy. So that's why these guys on we follow the 0DT options, so that's why they tend to take profits here, and we can take advantage of that, right? As we can see. Now, let's gonna see what's in the control panel of Gexbot Classic. So we can select the ticket, SPX or whatever. I do recommend, if you're trading ES, right, you need to follow SPX, or these guys already have it. You can convert ES into SPS. So you can select a bunch of options. Even myself, I trade Nasdaq futures and Q. I have my class in SPS. Why? Because this is despite this is being a hedging instrument for institutions. Why? This gives us a really good profile, really good targets, right? I've done it, and I can tell you, if you want to trade ES, follow the SPX, right? Then we can select the 90 days, the 0DT and 1DT, right? When you select 90 days and 0DT, it might give you more or less the same profile. 1DT are options guys who trade the next day. These guys can manage risks more effectively than 0DT. Think of 0DT if you go into Formula One, right? You're going to get a car and you're going to drive a nice Ferrari into Formula One. So you have to be very sharp. You're going to go at 300k per hour. So you have to be very careful of all your Greeks, theta, gamma, all of them, charm, banner. But when you trade 1DT, yeah, you're still going to a race, but you go slower, right? You have time to react. You have time to see how to manage your risk. So what we like to do, we would like to see 0DT options, and now and then during the day I toggle to 1DTE because I want to see what are these guys doing, where are they taking profits, where are they taking their major positions, right? And that's very important. Now, what's important also is volume, right? But what we look at is the net of gamma, or the net guess, right? The gamma exposure. If it's negative, basically it's telling me that in general the market is trending lower. If it's positive, obviously the vice versa market is trading higher. I'm gonna explain how I use this in a minute, but keep an eye. This is where you see the net guess, net gamma exposure, and you can see also the zero gamma. I'm gonna teach you how to read zero gamma too in a minute. And this is very important, the mass change gamma exposure. When you see, this is how the biggest or the maximum change has happened in the last minute, 5 minutes, 10 minutes, 15 minutes, and 30 minutes. So if you are trading with gamma exposure and market is trending down, it hits your major negative level and you are long, what you want to see all this mass change to go positive, right? What is this showing when it goes positive? Showing that now everyone who was selling options is buying options, right? Is all this kind of negative gamma is now being bought. So when they buy back any option position, we can see the gamma here. So when you buy, when you buy here from the major negative gamma, what you want to see is all this positive. And also when you sell on major positive gamma, you want to see this mass change to go negative, right? Now, as I said before, let's gonna talk about the zero gamma battleground, right? This is where the fight happens, and I'm always aware of this zero gamma, right? This is one of the most important but less understood concepts, right? So what's the zero gamma? The zero gamma is the level where, if you see the profile, you see like kind of two profiles here. You see like kind of curve profiles. It's very difficult to see who is winning, right? Who is winning, the buyers or the sellers? The call gamma or the put gamma? It's very difficult to see with this kind of just profile. But this is why this panel is so important. So the net gamma exposure, it shows, or look, the sellers are winning at the moment. It's more selling pressure, but also the zero gamma is such an important concept, right? This is act as like a volume point of control. If you guys have seen the volume profile theory, right, where they do like this value area high, value area low, and the BPOC. I mean, the way I learned when I learned this is like you never trade at BPOC. Why? Because BPOC is where buyers and sellers are kind of happy trading to each other. There is no imbalance. So basically what you have in BPOC is like you have this kind of, ranging market. You want to go short, market rallies, you want to go long, market, goes down. So you don't trade a big poke. What you want to do, you want to wait for the market to get away from big poke or trade at the high nodes or low nodes. But this is more or less the same. If you think about zero gamma as that big poke, it's a place where you don't want to trade. When the price is around this level, you don't want to trade, right? And as I said before, why? Because this is the place where buyers and sellers fight. Now, when the price moves away from zero gamma, now we have a visual representation of who won that battle. For instance, in this example, we can see that the sellers won that battle. They were battling around there, and then they won the battle. Also, here, when the price, look, this is a perfect example. Price went down. You have a little bit of fight here around this major negative gamma in the morning. That was too early in the morning. So look, the real positioning on the market on that day, that was the 12th of March, the real zero gamma, major negative gamma was around this level. And see how the price, first of all, it moves in the battle, it moves from above to below, from below the zero level, right? Then it has some sort of tricky area, goes down to the major negative gamma, and look how it bounces. Bounce all the way back. So this is what I mean when I say, if you want to have a system that give you 1 or 2 trades a day, high profitable trades, this is Gexbot Classic. And as I said before, the SPY, I'm using the latest tools of Gexbot. I always look into this, always look into this every day, right? And the next concept is very important because the zero gamma is the battleground, but you will see some clustering sometime. You see the line is perfect line. Price go up, down. We have some clustering like clouds. Basically, what if you imagine? You guys tell me, why do we have the perfect line here, and here is like up and down, same in here, up and down. It looks like it goes back and forth, but no. What's happening? This is the battle between buyers and sellers. We cannot detect that battle here. We see some lines going to the left, some red lines going to the left, some green bars going to the right. But when you see zero gamma, you see the real battle, right? You see these guys fighting. Here. You see these guys fighting. Is who is winning the battle? It seems to me the sellers here won the battle, and then zero gamma shifts lower. They start to battle again, and then the price crossed below zero gamma. At that time, at this moment, if you are trading, you should be thinking of trading short, not long. Why? Because we are below the zero gamma. And look how nice the price tried to reach to this level, but then it goes down to where? Again, major negative gamma, where the price found some support and then have some rally. So if you have a look at this, you could have 2 perfect trades. One, just wait for the price. Okay, let's imagine. Let's be realistic. Let's be real on this. Imagine the price cross. We have the battle here. Price cross the zero gamma level. So you went short, right? What would you do if you go short with 5 contracts? You take some scalps, you take profits, and left a run-up. That's what we do every day. That's what I do every day. And I post my trades in the channel. I left a run-up and put a stop loss just above the zero gamma. So I made some money here because I went short, took profits, left 1 or 2 runners. They went and stop out. No harm. And then market goes here and then start to retrace again. Now, if you see market structure, if you see my other videos, I like to read the market as a market structure. And look, we have a high, then we have a low, then we have a lower high, and the price cross against zero gamma. That's where you go short again, right? You take some profits on left some runners above the zero gamma, and look how nice that trade would have been, right? Then you take profits here. So you make all this money by following this simple strategy. and it has some maths behind it. It has some reality. It's market, like the big institutions, the market positioning in the options market that moves the other markets, right? The futures. Now, if you feel it's not even 11 o'clock, it's like 11, like 10, I don't know, 10:45 maybe. So then you take your profits, and once you see the market start to come back, you know all the options guys who were taking these positions down here, this is where they take profits, right? This is the 25 or 50 max gamma, and we know why they take profits. So you can go long because market maker has to buy back all the shorts he took into the futures market to hedge his position, to hedge his portfolio. So options guys take profits, liquidate their options, and market maker has to buy back all the futures. So here we go. You go with them, right? You go with the institutions. That's why that's the power of Gexbot Classic, right? Now we were talking about clustering, right? It means there is war. Now this happens again. Obviously, if you want to take a long here and you put your stop loss, yeah, that's fine. That's trading. It's not 100% perfect. But look what happened. Now what you have another clue. You have this clustering, right? It's a battle, up and down, up and down. What is this telling you is this is shifting, right? Again, I wouldn't take this position because I don't have any negative major gamma, right? But look how it works. All this is being battled. When you don't have a clear line, it's just battle between buyers and sellers, like calls and puts, until someone wins, right? Now, the other trade that you could have take is go short here. No, it's the opposite of this one. So you go short again. Apologies. You take profits, leave some rana. Maybe you get a stop out here. You go short again, take profits, leave some rana. Okay, and that the day you would have made so good money on this tricky day. I remember this day. That was the 7th. That was tricky. I think it was Friday or something like that on March. But that's how you use the clustering. I don't say that you go and take a position when you see the clustering, right? But it means that after this clustering, the price tend to have like a clear direction. Don't enter on this clustering, but be aware that when this happens, the power is shifting. So we've been trending down. This might be shifting when you see this, right? And you see how it changed. Now, let's go for some examples of zero gamma. This is the one that we just mentioned. That was on the 7th. This is on the 10th of March. Look how the market start. It was battle. You see this clustering here, these clouds of zero gamma. It's not a line. It's just cloud. It's just clustering. That's a battle, right? Then the result is, as I say in this, sorry, I forgot to mention, once once this fight has finished, you most likely will see that the price tend to have a direction, right? So here, look, it was a fight, clearly sales took the lead. You could take a short here and put your stop loss above here, and look, this is your target. This is where you would have had made your money, okay? Now, look how they achieved the max negative gamma. So if the max negative gamma stays here, I'm pretty sure the market would have rallied, right? Because I know the market, all these guys positioning on puts would have take profits here. But look what happened. That was the day the market went down on the 10th. It was like one way down. So look what happened. They shift the major negative gamma lower. So what is that telling you is this market is going to have a continuation lower. So what do? You just wait for a reversal, wait for the price to go and test the zero gamma. If it doesn't test it, that's fine. You don't have a trade. But look how it tested, and then you can enter here short with your stop loss here. You already make good money here. Look, you make all this money, you just raise a little bit of your profits, and then you would have all this night trade up to here. This is your target. That's what I mentioned at the beginning. This could be your target or your entry, but since you are sure, this is your target. People using like 20 moving average, RSI, MACD, all this nonsense. They get scared and they get out quickly. because those are lagging indicators. It's nothing to do with market positioning. So they would get out here, they would get scared, get out here on the short. But look, this is position analysis. This is showing when the big guys are positioning in the market. So that's fine. You take your shorts, make money, take another short, and make an amazing money. This is another example. Look how the market was battling here. You see what I mean? The clusters is not a straight line like in here, but it's just up and down, up and down. Market go down, retrace, and again finds resistance on the 0 gamma. That wouldn't have been a nice short. And where do you take your profits? Again and again and again. I see this in the market every day. So look, that's what I mean. With Gexbot Classic, you can get 1 or 2 trades, like high quality trades in the market. Look, and this is your profit. You take profit here. Now, it's not even 11 o'clock in the morning, right? So you have some time because options expire at 4 p.m. So you could take a long here out of this major negative gamma, scalp some, leave a runner, take more profits. Goes down here, you get scared, maybe you close your position, but now you see it's working again. So you can go long again and take profits, leave a runner. And where is your runner? Maybe to the 0 gamma. But again, look the clustering. Look the price activity here, and look what happened with 0 gamma. You see, when you see 0 gamma in clustering, honestly, this is amazing because you can see the battle of guys in the options market. So my job is not to be clever. My job is to go with these guys. And when there's this, I know, these guys are battling, puts and calls, they're buying, they're selling. It's just crazy. And again, look, this is market structure. You go like kind of double top, then you go to lower high. So you go to high, at lower high, a lower high, a lower high, and then the price breaks again. You make some good money on the way down. You make some good money on the way up, but you can risk a little bit and go short. And look, this is your target. And that's what I mean. If you're using, all these 9 moving average, simple, the 9, the 12, the 21, the 50, 100, 200, whatever, you would get out on this little retracement. But when you understand the power of market positioning, these guys are the guys who move the market. No on RSI, no on MACD. It's the actual guys. This is the volume, right? If when I understood that volume is what moves the market, and then when I understood with Gexbot that I can see who is putting that volume and where they're putting that volume, that's where you make money. Look, you would have made so much money here as well. And look the clustering. You see? 0 gamma is trading very nice down. And then you see this clustering. So this is battle. Someone in the options market wants to change the current regime, and they made it. They did it. There was a battle here, and then they changed the current regime. Once the price crosses the 0 gamma, you can go long, put a stop loss below, and where is your target? Here, right? So that's what I mean. With this Gexbot Classic, you can have 1 or 2 high quality trades a day. That's all you need. You don't need anything else. And guys, I tell you again, I use this every day. Even though I use order flow and state, I always look into Classic. This is my main one. This is how I started with gamma exposure, and this is fantastic. This is another example. You can see battle. Market results, let's put it that way, sellers won the battle, profits. So you would go short here, take profits here. Now look how they shift the negative gamma down below, right? This is the 12th of March, right? A little bit of market structure would tell you, we're making lower highs and we have a support here, which is broken, right? I wouldn't necessarily take a position here, but I'll be aware that we are below the 0 gamma, so we are in a downtrend regime. If you were short here and you manage, you went short when the market crossed the 0 gamma and your stop loss in here, let's say you took some profits here and it's crazy, and if you manage to go short again for any reason, look the target, right? This is the target, the maximum negative gamma. But let's be let's be talking a second scenario. You went short here and you took profits here, right? And you miss all the move down. This is FOMO. You know, when the guys see they miss the move. Oh, I missed the move. I missed the move. Oh, it's going lower. I missed the move. I missed the move. You know what happened? 90% of the time they sell here, and once they sell, market rallies a little bit, and they get out in losses. And then as markets start to get down, and they already lose their money here. If for any reason you manage you short, right, and you miss, you took profits here and you miss the whole movement down, no worries. As I said to some guys that I give some advice, why you worry? Just let the market goes to this maximum negative gamma and go long. Look, yeah, you probably miss this move, but by going long, you make all this money. It's amazing. It's fantastic. Honestly, this is position analysis. This is where the big guys in the market are positioning. Don't tell me that the market rally because, 2,000 traders around the world decided to buy here and they move the prices up. No way. The market rallies because big guys with big pockets, they put money on the downtrend. And once they hit the maximum negative gamma, look, once they hit the maximum 25 and 50 gamma level, they know that even if the market keeps going lower, they're going to have diminishing returns. So what they do, they take profits. That's it. And market maker who's been selling futures on the downtrend, well, they have to buy back the futures. I used to be a market maker in London, and I have to do this all the time. I have to hedge my delta. Despite I was market making the derivatives in the FX market, which is forwards, no options, which is linear, but I have to hedge my delta. So many times we have big flows from big guys, and maybe I can't tell you here since I'm not working there anymore. Well, we have big flows from central banks. This Central Bank of England came with huge money into the derivatives market. That's fine. Derivatives market is huge. But then I have to go out to the spot market to hedge my delta. And that's where I was selling to hedge my delta. Now we're talking about options, and these guys, they are non-linear. So they have to be careful of the delta, but they also have to take care of gamma, bana, charm, all these derivatives. And look, that's why the market rallies, because these big guys have to buy, they liquidate their short positions, let's put it that way, because they're options structures. And market maker, who was selling the futures, have to buy back. Amazing trade. What's the risk? Nothing. You just wait for the price to, reverse, and you put your stop loss here, which is, you're not going to, 9 out of 10 times, you're going to have a winning position. I promise. That's the statistics. And where do you take profits? Maybe you can take profits here because you see the clustering. And you know that when there is clustering, there is battle. Now you see this, and you can go long if you want. You make some, you made some good money down here. You made some good money up there. You just buy here and put some stop loss here, right? And then where is your target? Wow, your target is above here. Look, the major positive gamma. But you have to be aware that as time passes, look, always be aware of time. As time passes, this target, and if the price doesn't get there, it's going to be more difficult to get there because these options are going to expire. So by 3 o'clock, your option is going to expire. So you have to decide what to do, right? If you want to take some profits, or if you want to just leave your stop loss somewhere and take some profits. You go like kind of double tops, so you can take your profits here. But it's also because of time. It's not because this doesn't work. It's because of time. And also be aware, this works because big guys, again, they know that they're going to go long here. So they also bought structures with the upside potential, right? The same guys who were selling, let's say, these structures in the options market, they were buying structures to go here. They couldn't. So most likely they get out somewhere. But, 2, 3 beautiful trades, that's all you need. Now, we're going to talk about one of the biggest mistakes traders make is trading against, the dominant gamma flows. So how you can avoid that? Well, if we are below 0 gamma, you don't take longs unless we are in a reach the major negative gamma. If you are above if you're above the 0 gamma and you have a positive regime, which I'm gonna show you how to do it, you don't take shorts. Well, you see the market goes down and down, but your probability is low. So how can you avoid bad trades? Right, we have this panel on the right hand side, and if max change gamma is red, so if you see all of these going red, 5 minutes, 1 minute, 15, 10, 15, 30 minutes, and the net gamma exposure is also negative, and we are below the 0 gamma, you avoid longs, right? Unless you hit the major negative gamma. You don't go long anywhere here. If this net of gamma is negative and all this max change is negative, you only go long when you hit your max negative gamma, right? Which is this one. Now, on the other side, on the other way, if everything that you see is green, right? You like this, max change gamma is green and your net gets is green, right? You don't sell, right? So if you're here, you don't sell unless, look, you don't sell unless you hit a major positive gamma, right? Let me see if I got an example here. Right, that's here, this one. So you don't sell in here because we're above positive gamma. Most likely, mass change is green and net gamma exposure is green. So you sell in here, right? That's where you make your money. You sell in here. You don't sell anywhere else. Look if you try to sell in any other level, we are in an uptrend, right? So you would take a little bit profits, maybe a stop out, little bit profits, a stop out, but here you have a nice move here. And then, price try to go up again, and you could sell again, and you put your stop loss very tight, and that's it. Well, you make all this money, and you lose a little bit, right? And that's what you do. That's how you use this panel to avoid bad trades, right? So basically, by following this simple framework, you filter out bad trades and only take high probability setups. And again, guys, I use this every day. I use this and I just wait, and I use obviously other tools, but this one is my main one. This is what I see every day to see which regime I am. If I am, down this regime, max gamma is negative, I would have gone short here anyway. I don't go long. I only take profits here, and then I wouldn't go long here. That's how I use it. And then I use order flow and other tools to kind of scalp and add positions. But listen, if you're a disciplined trader and you want a system with 1 or 2 high probability trades, like good trades, Gexbot Classic is for you. Okay. And now, why Classic works, right? And how Classic detects the market control. Yeah. So why it works so well? So in a simple way, what Gexbot Classic do is calculates gamma by netting out calls and put volume at each strike, and they apply what is called a spline interpolation, right? And they create a smooth curve, which is the curve of dominance. And they have some crossover points, right? That reveals control. So basically, when the price crosses from below to above, that kind of curve, a spline curve, that basically is telling me, oh, the control now is on the upside, right? But if the price crossed that y axis of the curve, you don't see it here because that's a calculation that is behind the scene, but it's so good and it's so clever that basically is telling you who has control and when and how they have it, right? So that's I know I'm a guy who, when I want to use something, I want to understand what's happening. So that's why, guys, I'm telling you, this is an interpolation. It's a very clever mathematical way to see at each point who has control, the calls or the puts. So that's how it is. Now, what it shows, like it shows where the market makers needs to hedge, the maximum and minimum gamma. Also, if you see a letter, if the price is going lower, right, and you see this big, like the red is bigger than the green, you will see it sometimes. That will give you the confidence the price is gonna go lower and it's gonna reach my target, my major negative gamma. So is that who reveals who is dominant, buyers or sellers? And it helps you to anticipate the next move before it happens. Buy on major negative gamma, sell on major positive gamma. You get to the tick. You guys won't believe, but sometimes I trade like 10 minutes on these levels because my risk is so small and my potential profits are huge. And I know even advanced quant traders use this tool for a reason, because it works, right? Why? Because if you track who is in control, right, you can position yourself in the right side of the market. So I don't believe on moving average or anything like that because they are lagging indicators. I used to work for an investment bank in London, and once I learned how to code in Python, the first thing my boss told me to do is go and do a code who can combine 10 or 12 indicators and give me the best one. We have like 12,000 interactions. None of them work. RSI with 9 simple moving average, or the 50 moving average with the MACD, name it. We have like 12,000 interactions. None of them work. So this works, sorry. This works because, listen, this is to know who is moving the market. When are they moving the market? Where are they putting their positions and where are they taking profits? That's why this works. And I've been using this for 2 years and I'll tell you this works. It works. There is no other, I don't think there is any other way that you can actually have a high probability, success in the market. You need to follow you need to follow these guys. I used to be one of these guys in London, but not because I was a big guy, it's only because we have big flows from clients, big clients, central banks, big institutions, hedge funds. They are the clever ones. All we have to do was, hedging my delta, selling the spot or buying the spot and moving the market, taking liquidity. So that's what I learned and that's what I understood. At that time I said, if I ever trade as a retail, I need to follow the big guys. I'm not going to follow RSI or MACD or whatever. I have to follow the big guys. And that's what I found Gexbot Classic like 2 years ago. And it's been amazing. So conclusion, and let's recap. So trade with the institutions, not against them. Watch major gamma levels, positive and negative. Zero gamma is the battlefield. When it moves, you have a cluster, you see the battlefield, and once the price takes one direction, that's the direction. That's the winner has been revealed, right? Avoid bad trades by following mass gamma change and net get volume, right? These ones, don't get into a short position if you have this situation. Don't go into a long position if you have this situation unless you hit major negative or major positive, right? And also use the zero gamma to see where the market is more likely to keep going. Well, and Gexbot Classic, the coach who is in control of the market. Simple tool, yet so effective, right? Okay, guys, if you found this valuable, make sure to like the YouTube video. And if you got any questions, just drop a comment. You can send me an email. And if you want me to break down in more advanced Gexbot strategies with the state or order flow, you let me know. Let me know where we are. We also have the Gexbot guys. They have a channel as well. I think when you have the subscription, you can get into the Discord. You drop a message to them, and they are always happy. To answer questions. I talk a lot with Giles and John, which are the founders of Gexbot, and I don't know how they do it, but they're trading, they're coding, and they're replying every single question in the Discord channel. Okay, guys, so trade smart, follow the real market movers, and stay ahead of the game. This was Freddy Sarmiento. Thank you so much for listening. Any questions, I'll be here. Cheers, guys.